Hello and welcome back to another video where I'm going to talk about an easy and low-cost way to invest on your own as a Canadian. I get questions all the time like, how do I start investing? Or how do I avoid high-fee mutual funds? Well, I can give you a great option to get started and avoid those fees, and it starts with 3 simple words: asset, allocation, ETFs. But before I share anything more with you, I want to say a big thank you to today's video sponsor, BMO ETFs. Now, I've been partnering with BMO ETFs for years now, and here's why. I like their ETFs. They also offer some great and free educational content on their website, etfmarketinsights.com, and their ETF Market Insights YouTube channel, which I will link to in the description of this video. They also have over 25% of the Canadian ETF market share, and are Canada's second largest ETF provider, meaning that lots of other people besides myself also like their ETFs. But most importantly, we just share the same values, which include educating Canadians about investing, but also specifically low-cost, simple investing in a diversified portfolio of ETFs. Now, if you want to learn more about what a diversified portfolio is and why it's so important, make sure to check out this recent video I did all about it. But one of the easiest ways to get that diversification is to keep things simple and invest in a fund that's already diversified, like an asset allocation ETF. And yes, I do invest in an asset allocation ETF for one of my retirement portfolios, have for years, and absolutely love how simple it is. Thinking of that video I did on diversification, the comments were actually really interesting. I got quite a few comments from people sharing what ETFs they own, and some even invested in asset allocation ETFs, along with a bunch of other ETFs, which I didn't quite understand. And what I tried to explain in my replies back is that if you're invested in an asset allocation ETF, you don't necessarily need to then go and buy a bunch of other ETFs, because likely you're already investing in those same markets and companies. And so what you're doing is then becoming overweight in certain markets and/or sectors, creating an imbalance in your portfolio, meaning you may not actually be adding any more diversification to your portfolio anyway, or making your portfolio better. Think of building your portfolio like you're making a pizza. You've got the dough and the sauce and the toppings. It's perfectly balanced and tastes amazing. But if you decide to add more onion and garlic when it already has the perfect amount, well, now it's too oniony and garlicky and throws the whole flavor of the pizza off. Or what if you keep on adding cheese? Now, I know we all like cheese, and I could just be speaking for myself. I don't want a pizza that's like 80% cheese. Now I'm just eating a melted block of cheese when I wanted a pizza. Balance is what you need for the perfect pizza, and balance is what you need for the perfect diversified portfolio. Now, just to give you a clear look of what I mean and why once you buy an asset allocation ETF, you're good. You don't need to add any more toppings. Let's look at the BMO All Equity ETF, ZEQT. Now, for someone with a high risk profile who has a long time horizon for their goal, like someone in their 20s or 30s investing for the next 20 to 40 years for retirement, in my opinion, ZEQT would be a great asset allocation ETF to buy. It's well diversified with a low management expense ratio, MER, of only 0.2%. It's the perfect pizza. Looking under the hood, here's what's inside as of November 27th, 2024. 46.28% in the BMO S&P 500 Index ETF, ZSP, 25.26% in the BMO S&P TSX Capped Composite Index ETF, ZCN, 16.77% in the BMO MSCI EFI Index ETF, ZEA, 7.61% in the BMO MSCI Emerging Markets Index ETF, ZEM, 2.82% in the BMO S&P US Mid Cap Index ETF, ZMID, 1.29% in the BMO S&P US Small Cap Index ETF, ZSML, and negative 0.02% in cash. Now, what that all means is you're investing in 100% equities, stocks, with about 25% in the broad Canadian stock market, 50% in the broad US stock market, 17% in international markets and 8% in emerging markets. To me, this is a very nicely balanced all equity portfolio. You could easily just keep buying more and more shares of this asset allocation ETF for decades to come, and you will likely reach your retirement goal by the time you wish to retire. And that's really the only action you take depending on your situation. Just buy more shares. It's that simple. Moreover, some of the great benefits of investing in an asset allocation ETF is you don't need to worry about rebalancing your portfolio. It will always keep to its target asset allocation because it auto rebalances. And then to automate things a bit more, you could also set up a dividend reinvestment plan, a DRIP, through your discount brokerage. So whenever you earn any dividends, it would automatically reinvest those dividends and buy more shares of that ETF for you. So really, investing in this way would take you no more than maybe a cumulative hour or two per year to manage. And that's what I love about passive investing. It's so passive. You can set it up and spend hardly any time on it and potentially benefit from market returns that will compound over the years to come. That's why I say that buying an asset allocation ETF is literally one of the easiest ways to invest on your own. Not to mention, so much more cost effective than its alternatives, like having an advisor invest for you or investing through a robo-advisor. Because your only costs are the 0.2% MER and any commissions your discount brokerage charges you, though there are now many no commission discount brokerages available to avoid paying any commissions. But going back to why it may not make sense to invest in an asset allocation ETF plus a bunch of other ETFs, let's pretend you buy shares of ZEQT, but also the BMO Nasdaq 100 Equity Hedge to the Canadian Dollar Index ETF, ZQQ. Here's a side-by-side of ZSP, an ETF inside ZEQT, and ZQQ. NVIDIA, Apple, Microsoft, Amazon, Meta, it keeps going. You're investing in two different ETFs, which could include some of the same stocks with the potential for overlap, which both have big allocations in the tech sector. Needless to say, your portfolio is likely overweight in tech. Similarly, looking at the side-by-side of ZCN, which is inside ZEQT, and the BMO Canadian Dividend ETF ZDV, we've got Royal Bank, Enbridge, Canadian Natural Resources, Bank of Montreal. Again, these ETFs are investing in a lot of the same companies with a big allocation in financial and energy companies, likely making you overweight in those sectors too. It's like ordering double sauce, double cheese, and double toppings on your pizza. It sounds like a good idea, and then when you get it, it's too much. It's just too much. Now, I don't want to make you feel like it's always a bad thing to invest outside of an asset allocation ETF, but it only makes sense if you're investing in different things than what you're already investing in. For example, if you added a real estate investment trust REIT ETF, like the BMO Equal Weight REITs Index ETF, ZRE, or a precious metals ETF, like the BMO Gold Bullion ETF, ZGLD, to your portfolio, that would actually make more sense because those assets aren't already inside your asset allocation ETF. You'd potentially be diversifying your portfolio even further with those additional ETFs because they are uncorrelated assets to equities. Or if you want to create your own flight path with your portfolio, you may want to slowly add 1 or 2 bond ETFs into the mix. For example, as you slowly approach retirement, you're going to want to make your portfolio less volatile and thus less heavy in stocks. You do this by changing your asset allocation from 100% equities to say 70% stocks and 30% bonds, maybe 10 to 15 years before you want to retire, eventually landing at 60% stocks and 40% bonds in retirement. This is so you can reduce the overall volatility of your portfolio in case there are any market crashes or corrections when you're retired, but also it can help you earn more consistent cash flow with the interest generated from those bonds. In that instance, you may want to add on something like the BMO Aggregate Bond Index ETF, ZAG, on top of ZEQT. Well, I hope you found this video insightful and now understand that keeping things simple is a great great way to invest so you can grow your wealth and reach your goals. A big thank you again to BMO ETFs for sponsoring this video. Make sure to check them out at etfmarketinsights.com and their ETF Market Insights YouTube channel, which has some really great resources to help you become a more informed and confident investor. Just remember, a complex portfolio with a laundry list of different stocks or ETFs doesn't mean it's a better or even a good portfolio. Sometimes you can just buy one ETF that has everything you need inside it, and it really can be that easy. I mean, there's a reason I've been a passive investor for years. I wanted to follow an investment strategy that made logical sense to me, and it was easy for me to maintain for decades to come. But I know I've gone through a lot in this video, so if you have any questions at all, please put them in the comments. I'm always happy to help. Well, that's it for me. Thank you so much for watching, and I will see you in my next video.